right. Hello, everyone, and welcome. Thank you so much for joining us today. Without further ado, it's my pleasure to introduce to you Ina Rosputnia, a stock and futures trader and the author of the book Basic Instinct of Trader. She's also the CEO of Managed Accounts IR, a financial expert and an analyst who writes for Benzinger, the Businesswoman Media, Investing.com, along with other publications. To our live viewers, please type any questions that you may have into the chat box, and time permitting, I will announce those at the end of her presentation. With that all said, Ina, I'll be right here if you need anything, but I'll hand the mic over to you now. The floor's all yours.
Thank you, Charlotte, and thank you everyone for coming to see my today's presentation. So today we will talk how to prosper in inflation years. Invest in inflation, it's the only thing going up. Will Rogers once said, well, don't worry, it's not the advice I'm going to give you today. But on the serious note, inflation is always here. We live in the times of inflation and it's a normal part of economy. The other problem is when it reaches some extreme level and it becomes dangerous for the economy. So this is exactly what we have seen recently and what we still partially experience. But there are good news. Inflation can be easily focused. It doesn't mean you will be able to focus the strength, or it will be more correctly to say the level of inflation, but you can focus the timing of inflation rise to begin and also of inflation rollover. So this is the chart with inflation and cycles. Cycles are marked the red line, and it was done last year. And as you can see, based on the cycles, we should have expected inflation to go down. And this is partially what happened because we did see a rollover in inflation. It's not going straight down, as always with the cycles, and nothing moves straight in one line, right? We always see some kinds of pullbacks, if you will, and the same with inflation. It will continue to drift to the downside, but it won't be an easy path, and we will see some reporting periods with slight rise in inflation and then some slide in inflation. And based on the cycles forecast, we have just started rolling over period, and we can expect the bottom of this cycle at the end of 2025 or beginning of 2026. So this is talking about the cycles, and as you can see from previous years, inflation is, and there's no reason to expect it will change the way it moves. And also important things to know that jobs lead inflation, and at the moment that looks very bullish to me because based on the labor market in the United States, we can expect inflation to decrease and to continue to decrease. Again, it doesn't mean that we will reach a safe level or so admired by Federal Reserve 2% of inflation, because none of these indicators nor cycle used as the timing tool for major reversals to the upside or to the downside in inflation. And this is it. Don't expect something else from this. Focusing on the level of inflation is very difficult, and in fact even the pro-economists can do it still, because so much things influences the level of inflation. So we can only, as a traders, as investors, we can only use the information we have and adjust our trading and investment decisions in accordance with the cycles, with the inflation, and with our view of economy and markets. So Is inflation always dangerous for the stock market? I believe that most of you will say yes, because high inflation means almost always a recession. And in some way it's true, because usually when we have inflation above 5%, we see market entering, economies are entering into recession. And this is what mostly happens. And let's have a look at this chart. The red line is inflation above 5%, and almost each time the market, the economy entered the recession, and the decline in the market followed. But we have few exceptions, like right here, 1, 2 moves above the 5%, and the recession didn't happen. While still it might cause some short-term or middle-term weakness in the stock market, a rise in inflation is not always bearish. Critical levels of inflation, yes, in most cases, they are very bearish for the economy and for the stock market. But when it's rising itself, for example, from the level 2.5 or so on, it doesn't mean you have to close your portfolio right here, right now. It means that you have to make a deeper research and take a look at other economic indicators like unemployment rates and so on. So yes, inflation is very important for the economy and for the stock market, but only inflation by itself can't move the stock market. It can't reverse the economy. It can't put the economy into recession. In combination with the other negative downturns in economy and economic indicators, yes, it's possible. And it's what usually happens when we have high inflation. In most cases, we do have negative data from other key economic indicators, but not always. That's why you want to double check always what is happening in economy in general, not only rely on inflation. Again, this is the chart that represents inflation, Fed funds, and S&P 500. The red line is Fed funds rate. The black line is S&P 500, and vertical lines are consumer price index, CPI. So again, if you pay attention to that, yes, high levels of inflation usually cause recession and declines in the stock market. Like here in this particular example, here again we see, but it was very high level of inflation, right? But the decline in the stock market was quite middle compared even to this level when we had lower inflation, but still deeper decline in the stock market. Again, we have another rise in inflation, and the market entered into recession, but not a big decline happens in S&P 500. So this chart proves that, yes, there is some correlation, and there's certainly correlation, and there is an impact of inflation on the stock market, but it's not always the case. It's not always the crucial power for the stock market to decline. And also, as I mentioned before, it's almost impossible to predict the level of inflation, and the same with the stock market declines. It's almost impossible to predict correctly the level or the strength of the stock market decline. So this amplitude, like here it was very big one, here it almost didn't happen. So it all depends on the certain conditions, on the economy, on unemployment, especially, because what I learned over the years, the unemployment is even more important indicator for the economy and for the stock market than inflation itself. But still, as a trader and investor, you need to understand the historical influence of inflation, because what we see in news, what we hear from different economists is very good. It's good to know somebody's opinion, but historical data matters the most. So before trusting someone's words or even make your own conclusion, just always come back to the historical data to see how it worked previously, how reliable is one data or other, and do your own conclusions based on our past. Is gold a good hedge against inflation? Some time ago, it was like half a year ago, I was here on Money Show and made the presentation about trading gold. So if you was there, you likely remember that the gold is not the perfect hedge against inflation or even a recession, especially a recession, I would say. So here's the chart. The yellow line is the gold price and the red line is a consumer price index. As you can see, they do have some correlation, but not always. It's like 50-50%. Not the most reliable winning rate, I would say. So for gold to be trusted as the best hedge against inflation. And Warren Buffett once said, gold is a way of going long on fear. And it has been a pretty good way of going long on fear from time to time. But you really have to hope people become more afraid in a year or 2 years than they are now. And if they become more afraid, you make money. If they become less afraid, you lose money. But gold itself doesn't produce anything. I partially agree with Warren Buffett because yes, there is a time to buy gold, there is a time to be in other asset classes. And again, in presentation from last year, we discussed how to spot the biggest reversals and the best opportunities in the gold market. So basically what we hear from Warren Buffett is true. A lot depends on the fear in the market, and a lot when it comes to treating gold as the safe haven. When it comes to treating gold as commodity, it's a bit different because once again, here's another chart that represents gold price and CPI. So I think this chart looks less messy, so you can get a clearer picture of the interaction between the CPI and gold market. So certainly there are moments, sometimes it works good as the hedge against inflation, but not always. And here's time to get surprised about commodities and inflation. So this is commodity prices, Goldman Sachs commodity index, and the consumer prices right here. So you can see there is a strong uptrend in commodity index and in most of the commodities in the times of in the years of high inflation, and there is no surprise of that. But again, we have just saw the chart of gold and we see now the commodity index, and we can easily make up our mind that probably gold is not the best of the commodities to hedge against inflation. It might be surprising because everyone used to think that gold is everything, gold is best hedge against recession, against inflation, but the data shows a bit different picture. So by itself, commodity, yes, they are very, very strong during the inflation, and there is no surprise. We have higher prices of everything almost, right? But on the first place, when it comes to inflation, we see the energy and the agriculture, because gold becomes a safe haven in the times of inflation, but agriculture and energy is what people need for a living. No matter how good or bad people's situation is, they will still need food, they will still need energy, heating for their apartments, and so on. So the agriculture and the energy is a must-have for everyone, while gold as the commodity comes on the second place and as a safe haven as well. And here's the crude oil chart compared to US consumer price index. The blue line is energy oil light crude futures, and the red line is CPI. And you can easily see that compared even to the gold chart, the crude oil has much tighter relationship, intermarket correlation, not intermarket correlation, but interaction with the CPI and inflation. So when it comes comes to tracking inflation or trader, for example, or middle-term trader, it makes much more sense to pay special attention to crude oil instead of gold market, just based on the historical data on what happened previously. We can make this conclusion. It doesn't mean it will repeat time by time, but I'm very sorry, we had some kind of technical issue. So let's see the options for passive investors, because the previously mentioned options required a lot of time from your side. There are two options for passive investors. The first one is treasury inflation protected securities. This is the type of treasury security issued by US government that is indexed to inflation. It's not the best way of investing, certainly, but if you are very busy, can't do enough research, then probably as the hedge against inflation, tips would be good for you to go. And here is the basic characteristic of tips compared to treasuries, that includes interest rate payment, and a principal description. Again, if you are looking for the higher returns, then it might sense to look for the managed futures. Some of them might be US stock market futures like S&P 500, and others agriculture sector. And as you can see from this historical chart, the managed futures are marked blue line, and the red line is S&P 500. Even during the most turbulent times in economy, when the stock market was falling sharply, like right here, here's another example. Here's another example. The managed futures did very well. And it's not because you have an opportunity to easily short American stock market. It's mostly because during turbulent times, including high inflation, the portfolio managers were able to add the agriculture sector that is doing very well during high inflation, and that helped them to boost their returns and do much better than the stock market in average. And it's not occasional. As you can see, we have data from 1984. It repeats time over time. So here's a few more words to add about agriculture managed futures. During the most critical events over the past 35 years, they substantially outperformed the stocks, as you saw it from the chart. Moreover, over the past 25 years, a portfolio diversified with at least 20% with agriculture futures performed 62% better than a portfolio with just stocks and bonds. So this is the general data that gives a great insight into the markets, into how to prosper in high inflation years. And as I promised, we have few minutes left to answer your questions, if any, and if you are interested to learn more about the different kinds of investments and trading strategies, you can visit my blog, where I publish a lot of free research and also educational material.
All right. Thank you very much, Ina. I know that was difficult to get through with the connectivity issues, but we do appreciate you doing your best with us today.
Thank you.
Of course. Now, I don't see too much in terms of questions in the chat as of right now, but we have a couple more minutes to go. Any other closing notes or frequently asked questions that you'd like to share with us now?
Yes, one of the most overvalued indicators, I would say, is money supply. I often get questions on Money Show and other events about money supply. I think it's somewhat overvalued because when it comes to money supply, we have to take into account the increasing number of people living in the country and so on. So I would say that we are living in the times of increased money supply, and it's not necessarily a bad thing for the economy. And again, as I mentioned previously, unemployment data, or it's better to say unemployment dynamics, is the much better indicator and more reliable in terms of picking up swing moves in stock market.
Thank you, Ina. We did get one question actually. They said, are MF any managed funds or mutual funds?
It's abbreviation from managed futures. It's not a mutual fund, and personally, I wouldn't recommend investing into mutual funds because in average, they underperform the market. So it's even better to invest in S&P 500 just than mutual funds. Not
Right.
all the mutual funds underperform, but on average, yes.
All right. Thank you very much, Ina. Alrighty then, everyone. Thank you all once again for joining us and for your patience today, as I know we had some technical difficulties, but we greatly appreciate you sticking through it. To all of you who tuned in, be sure to stay tuned as we still have more in store for you throughout this virtual show. And Ina, thank you once again. It's always a pleasure to be your host. Love having you on.
Thank you. It's always the pleasure to be on Money Show.
Alrighty, everyone. I hope you all have a great rest of your day.